So again, welcome. Thank you very much for coming to the webinar. My name is Dave, and I'm with the Compass Options Trading Room and Text Alert Service. The trading room I have, I'm trading in there every day from about 9:15. I get in 10, 15 minutes before the market opens, just to kind of discuss the upcoming trading day. And then we start trading at, I'm there from 9:30 to 4 o'clock every day, trading live and calling out trades, identifying high probability trade setups, and also answering a lot of questions from folks in the room. We have lots and lots of folks in the room and on the alert service to go over those. So we do a lot of teaching as far as technical analysis is concerned, and how to use the methodologies that we use in the room. So again, good day, and let's get started. All right, so the first thing I have to do is do the disclaimer that everyone has to do on these. All signals and trading opportunities we provide here are for educational and demonstration purposes only. Trading is very risky, so you should never trade with more money than you can afford to lose. And neither myself or Right Line Trading are licensed financial advisors, so we won't be giving any financial advice. All right. By the way, if you have any questions during the webinar, you can just put your name and phone number or your Skype username in the chat box, and Rory, one of the fellas from Right Line, will respond to that to answer any questions that I can't answer. But you obviously are welcome to free to put questions in the chat box here, in the question box here, and I'll try to answer them as we go through the webinar. Okay, so we'll get started. It's just kind of a graphic representation of the Compass system, which I'll go into a little bit of detail on. It's a piece of software I use to identify institutional trades. And again, we track institutional money flow. That's how we're able to be successful consistently as far as trading is concerned. Okay, this is a graphic representation of what the alert service looks like. Basically, I send out alerts on only the highest probability trade setups. They go to your phone. I have them on my phone so I can tell how quickly they're coming. I usually get them in about 15 seconds from the time that the alert goes out, sometimes less than that. All right, the first thing I want to discuss, and I discuss this in every webinar, and it's really important. It's important to understand what moves markets and what doesn't move markets. This is a graphic representation of these little marbles here. These are retail traders such as myself and most folks here in the room. We're retail traders. When we're trading without institutions, and this is the institutions right here, when we're trading in the market without institutions, what you get is a lot of chop and a lot of chaos. So you're not going to be able to ride a trend one way or the other with just retail traders. We've got to have institutions in the trades in order to have a trend set up that we can take advantage of. So our job is to identify when the institutions are in there and when they're not, and to trade the stocks or the indexes that they're trading. Now the institutions are made up of investment banks, big investment banks, JP Morgan, Goldman Sachs, Morgan Stanley. All of the big investment banks are institutions. Obviously, they have billions and billions of dollars to trade or invest in the market. And they have trading desks where they have humans trading, but most of their trades come from what's called algos, the computerized programs that actually trade the market. And this is really important because about 85% of trades are done by algos, and they can react very quickly, much more quickly than we can. And the algos are programmed to look for specific setups. They're also programmed to monitor news sources, etc. So this is where the institutions, when they go in, we want to know about it. Now the institutions aren't just investment banks; they're also hedge funds. There's hundreds of hedge funds that again have billions of dollars to put into the market, so they're part of the institutions. As are large pension funds, they're also part of the institutions, and mutual funds like T. Rowe Price and Vanguard. More institutional trading. So these folks, this is where all the money is that's going to move the market. So our job is to find out when they're in there and trade with them, and when they're not in there, to not be in the trade. We don't want to be trading against these other retail traders when the institutions aren't in the trade. And as retail traders, when the institutions are in there, and we know the institutions are in there, and the other retail traders don't have the information that we have, we're going to take money from retail traders. That's where we make our profits, taking it from retail traders. So this is really critical, and basically trying to be successful in the market, it boils down to knowing when the institutions are in there and trading with them, and knowing when they're not in there and not be in trades when that happens. And I'll show you how we do that. All right, so we have in the room and on the alert service have a couple of basic rules that we trade by. The first thing is we trade the best and skip the rest. And this sounds really simple. It's not that easy to find the best, but basically what we're saying here is we only want to trade high probability trade setups, only setups that are likely to be profitable 85% of the time or more. So those are the trades we look, and if it's not one of those, we skip them. So we're not putting a lot of trades on. We're putting a limited number of trades on each day and each week, because we're only trading the very best ones we can find. And the second thing is our objective is not to make trades. Our objective is to make money. This is kind of important. What this says is if you're a trader, you don't need to be in trades all the time. You don't need to be in a lot of trades. If the market's bad, you don't need to be in any trades. So our objective is to make money, not to make trades. This means we've got to be patient and basically sit out the market quite a bit. And you'll see why we don't do an awful lot of trades each month. Now, as a profitable trader, as a profitable retail trader, you need an edge over the other retail traders. And the edges that I have, we have in the room and on the alert service, is I use a piece of software called the Right Line Compass System. I'll show this to you. This is what I run on Thinkorswim, and it's a piece of software that identifies when institutions are in a trade and when they're not. And this second thing we want to do is we trade with relative strength and relative weakness. And what I mean by that is when the SPY is moving sideways and down, and you've got a stock that's moving up, you've got relative strength. This is not RSI. This is how is your stock performing relative to the S&P 500 or the SPY index. And again, if you've got the SPY going up or going sideways and your stock going down, you've got relative weakness. So you'd want to trade relative strengths to the upside, relative weakness to the downside, obviously. We trade with the market trend if there is one. If the market's trending, we want to take trades that, if it's bullish, we want to stick with bullish trades for the most part. Bearish, we want to stick with bearish trades for the most part. And the last thing is to buy near support and sell near resistance. This is obviously a critical thing. We don't want to be chasing stocks that come out of the gate really fast, move up really quickly, or move down really quickly. You want to wait for them to come back to a support or resistance level and then enter. I mean, this is really important. So these four things together are going to give you a huge edge over the other retail traders in the market, because first of all, most retail traders know nothing about whether institutions are in there or not. They'll look at volume and try to make a determination based on that. That's not enough. And they don't even know about trading relative strength and relative weakness. Most of them haven't even thought about that for a trade. They just look at a chart, they like it, they get in. Okay, so the Compass system is a piece of software that I run on Thinkorswim that I'll show you. But this Compass system allows me to identify when institutions are in there. And it identifies the highest probability trade setups that are available, and then it sidesteps the ones that look good but will fail more often than succeed. And this is really, really important, and this is because we only want to be in the trades that the institutions are in. And again, this Compass system does this by identifying when the institutions are driving a move and when they're not. And we want to know when they're driving and moving, when they're not, so we can trade that way. Now, the Compass system does analyze a lot of complex trading data and displays the results in an easily identifiable visual format. This is really important because the data that it's crunching is fairly complicated, but the presentation of that information or that data on a screen is really easy to read, and it makes it even relatively simple for even new traders to identify bullish setups and bearish setups. Really important. So this is how we get our edge over retail traders. We only take trades that are being driven by institutions. The other most retail traders won't know this. We only trade stocks that have relative strength or relative weakness to the SPYs or the Qs. So we're actually trading stocks that are even stronger than the market for the longs and even weaker than the market for the shorts. And again, we want to trade in the direction of the overall market trend if there is one. Basically, we're trend trading. How does this give us an edge? Well, it gives us an edge because Our trades are going to be supported by institutional buying and selling. The stocks will be outperforming the SPY or the Qs, and they're moving in the direction of the overall market. So this is a key thing, and this is how we have an edge over other retail traders. And you'll see what kind of results we get doing that. Okay, just to kind of briefly go over what's called a high probability setup, of what criteria I use to constitute a high probability trading setup. First thing I do is I look at the daily chart of the stock that I want to trade. If I want to go long the stock, the daily chart has to be bullish. I'm not going to go long a bearish daily chart. And then we want the 5-minute chart to align. So when we get into a trade that has a strong bullish daily chart, then we wait for the 5-minute chart to also become bullish. In other words, get over a support or resistance level, and then enter the trade at that point. And since we're in the trade with a strong daily chart, for example, to the long side, then we can stay in the trade the rest of the day if we want to, or overnight, or a few days, as long as the daily chart stays bullish. Again, we trade with the trend, both the stock and the market. Compass indicators have to align. If I'm going long a stock, the compass indicators have to tell me that the institutions are in there buying. If I'm going short, the institutions have to be selling, and the compass indicators tell me that. So this one, the 5-minute and daily chart aligning, and this one, the compass indicators aligning, these are two critical ones. If you don't have those, you can't take a trade. I mean, as the trade drops through this funnel, the more of these check boxes you get, the more likely it is that it's going to succeed. But these two are critical: daily chart and the compass indicators. Then you want to trade relative strength and relative weakness. This also increases your edge because you're trading a stock that's outperforming the market or underperforming the market. And then you want to look for support, enter near support or near resistance. So wait for a stock, for example, if you want to go long, wait for it to pull back to a support level, bounce off the support level, confirm that it's back into the original trend, and enter. So this is what a high probability trade setup funnel looks like. If you take a trade, if you look at a stock, you want to run it through this checklist, and that'll tell you whether it's a high probability trade setup or not. This is just basically the same information written out, but you notice the stock to be traded should have a daily and 5-minute chart aligned, and the compass indicators must align in the direction of the trade. This is really important. Relative strength, very important. When you're trading on a 5-minute chart, there's a particular indicator called the VWAP, the volume weighted average price. You shouldn't be trading long if the stock price is below the VWAP, and you only want to go long if the price is above the VWAP, and only go short if the stock price is below the VWAP. This is a critical level that the institutions use. The institutions use VWAP all the time, and if you see them on your chart, you'll notice how many times the stock's prices come down to the VWAP and bounce right off of it, or go up to the VWAP and reverse back. Again, we want to enter the trade near the support for a long and resistance for a short. And have patience. This is really a key thing. You've got to wait for these trades to come to you. It's very important that you have patience. In the room, we try to have basically an atmosphere of as low stress room as we can. We're only taking very high probability trades. We're doing a lot of watching, waiting, looking for trades to take, and then when everything lines up, then we jump on the trade, and that's how we do it. So we're doing a lot of waiting on that. All right, in the room and on the alert service, these are the basic trades that you're going to see. Straight calls and puts. Obviously, we do a lot of straight calls, a lot of straight puts. I also do debit spreads using weekly options expiration. When I say debit spreads using weekly options expiration, they're expiring the current week. Unless I go in on a Friday, anytime I go in Monday through Thursday, that debit spread is going to expire that Friday. And we have a much higher ROI on these kind of trades than if you go out into the future on a debit spread. Time spreads over earnings. This is one we're going to be discussing today. They're also called calendar spreads. This is a strategy that we use over earnings. Now, the important thing about this is it's non-directional. We don't care which way the stock goes after earnings. We're not trying to game the system and try to figure that out. What we're doing is we're capturing volatility crush on these stocks, and I'll show you exactly how we do that and exactly what criteria you need to take those kind of trades. I also have a strategy called what's called the weekly ATM strategy. This basically is a strategy of selling puts every week against a longer dated put. So in other words, we've got a put out in time that we're long, and we're selling weekly puts against that trade week after week after week to capture premium over a few weeks. Sometimes it can be 8 weeks that we just keep selling these particular ones. We had a nice one on Google just recently. And then I do credit spreads to capture premium over a few weeks. This is a fairly standard strategy that most people understand, but understanding the criteria of when to take a credit spread and what the setup look like is something I go into in quite a bit of detail, and I have videos on all these things. Now, the one trade we take in the room that I don't send alerts on is what's called the SPY super system trade, and these are for very high probability trade setups to capture SPY moves and Q moves, upside or downside. But the SPY super system requires obviously the SPY to be at support or at resistance. It requires the market internals to be bullish if we're going long and bearish if we're going short. And it also requires the compass system to indicate that the institutions are either buying or selling the SPYs or the Qs right then. If it's neutral, we're not going to be in them. So those are the most of the strategies you're going to see inside the room and on the alert service. Now, to talk briefly about the compass options alert service, this is designed for day trades and short-term swing trades. When I say short-term swing trades, that can be anywhere from overnight to maybe 3 weeks. That's probably the outside limit, unless I'm doing a credit spread. About 3 weeks out. Most of the trades are only going to last a few days. A lot of them are intraday trades, but we do have a lot of overnight type trades. So that gives people who have under what's called pattern day trader rules, they can't trade more than 3 round trips day trades in a week because they don't have 25,000 in their account. But we do have plenty of trades that will be kept overnight, and those are not considered day trades. They don't ding you in those. And all of the time spreads that we do basically are overnight trades. So time spreads, credit spreads, all of those things are going to be multiple day type trades and won't impact your trading as a PDT. All right, again, alert service is designed for traders who can't watch the market all day or don't want to watch the market all day. We send these alerts out to get in and send these alerts to get out. They'll come to your phone. You can take the trade or set up the exit price that we set. You can just put it in there in your platform and then not worry about it. And we only send these alerts out on the highest probability trade setups, as I said. We only take high probability trade setups. That's the only ones we take. And we identify high probability trade setups, again, by understanding if the institutions are in the trade. That's important. And if the market internals are bullish in our favor or bearish if we're in our favor. And then we go into technical analysis, deeper technical analysis to find the best of the best. Okay, this is the equity curve of the alert service that they put together. This is assuming $2,000 is invested in each one of the trades that we do on the alert service. But this is since a little over a year ago. So pretty nice, pretty nice equity curve that you want. That's the one you want to see lower left, upper right. All right, so what I'm gonna do is I'm gonna kind of run through some trades that we've done in the last few months, quite a few months. And the thing I want to focus on here is not necessarily the individual trades, but I want you to understand the percentage gains that we're getting here. This is how you become successfully, consistently profitable, is to be taking out reasonable gains each trade, and not shooting for home runs every time. If you get an email that tells you that you can get in and make 500%, 600%, 400%, 1,000% on all of these trades, you cannot do that and be successful consistently at that. It's just not going to happen. It just doesn't. So these are the kind of percentage gains we see month after month after month. And you can see we have losers. Everybody has losers, but you can see we run here 23, 43% here. STX, that was a nice one, 108%. But this was our September's trades of last year. We did 25 wins and 2 losses, 92% win rate. That's a little higher than normal, but it was a good month. And if you invested $2,000 in each one of the trades, it created a profit of $77.88. A good month, and it was a very difficult month to trade, by the way, so very tough. This Amazon trade, by the way, was there was a news event that knocked it down on us, and we couldn't do much about it. Okay, October, same thing, 24 wins, 4 losses, 86% win rate, 44.80 profit, investing 2,000 in each trade. So you can see the percentages here just remain consistently. A lot of them in the 20s, a lot of them in the 30s, 61 here in JD, and a couple of losers along the way, but basically very, very consistent. And a lot of the percentage gains that you make on trades are going to be dependent on the market more than anything else. If you've got a trending market that you can stay in trades longer and maybe take larger size, then you're going to make more money. But if it's a choppy market, you're going to have to cut the trades more quickly, and especially intraday trades, and take the whatever profit you can get. You know, if I'm up 30% on a trade in a day and it's a choppy market, I'm going to take the profits. I'm not going to risk it overnight. If the market's trending up, then I might take part of it off and leave part of it on. All right, so there's that's the October trades, November trades, 21 wins, 4 losses, 84% win rate, 51.60 profit, pretty nice. Again, consistency across the board. Same kind of percentage gains, time after time after time. Here's December, very slow month for us. Only did 16 trades, 14 wins, 2 losses. A couple of losses here they are. And again, it was a pretty slow month, but the percentages stay the same. It's 63 at Microsoft, 36 McDonald's, Meta only 5%. So, you know, you just, the percentage gains you'll see are very, very consistent. January, a nice month. See the percentage gains here, very consistent, 20 wins, 2 losses, 90% win rate, 75.05 was the gain. February, I actually started breaking out the alert trades from the room trades in February, since the alert service doesn't produce as many trades as a room, because some of the room trades we take are too quick to actually post on the alert, because it doesn't give the alert members time enough to watch them. And also we take trades sometimes right at the end of the day, 1/4 to 4 or something, and I don't alert on those because, again, not fair to the alert members. They don't have time to produce it. But this was a February trades here. This was a big month for us, 92% win rate, 11,745. Some big profits in here, really, really nice profits, and probably one of our best months so far. And alerted trades, again, 20 and 2, 90% win rate, 69.30 on the alerts. What we did, I want to just kind of recap, because I'm just going over the results here before we get into the details. This was our 2023 trade results in the room, using $2,000 per trade. We investing $2,000 in each trade, produced a profit of $60,000, a little over for the year, using an account of $50,000, and I just use this as a baseline just to give something to go by. You'd be initially putting 4% of your account into each trade. And as the year went on, of course, that 2,000 in each trade would become smaller and smaller percentage of your account. And by the end of the year, 2,000 invested in each trade is less than 2% of the final balance, as the account grew from 50,000 to 110,000. All right, so that was 2023. This was the first quarter of 2024, right here. 65 wins, 11 losses in the room, 86%, 18.7. Again, 2,000 invested in each trade. You know, obviously that's not everybody does that. I'm just using this as a baseline. Obviously, if you invested 1,000 in each trade, it would be half of that. If you invested 4,000 in each trade, it would be twice that. The alert service was 41 and 6, 87% win rate for 12.2 profits. That's the first quarter. It's the second quarter of 2024. 65 and 14 on the trading room, 83% win rate, 14.8 profit. Alert service, 35 wins, 6 losses, 85% win rate, 11.7. So that's the first quarter and the second quarter of this year. Here are the May trades. I did start to pick these up again. This was May, 15 and 2, 88% win rate. You see the win rate stays around the same, between 85 and 90%. So 2,000 invested in May, 49.79. These were time spreads. I've got them highlighted in yellow because we're going to talk about those here in just a minute. But these were the time spreads we did in May. we had 8, we had 7 and 1 on the time spreads. In the options room in May, we had 29 wins and 7 losses. Quite a few more trades in the room than we had on the alert service, but we didn't make much more money. So the alert service worked out really nicely. Only an 81% win rate here, but 57.36 on the profits. And the alert service will receive all of the time spreads. All time spreads will go to the alert service. This was our June. We only had 1 time spread because there wasn't very many companies reporting earning in June, since earnings season was pretty much over, getting ready to come into July. But again, in the room, 25 and 4 for an 86% win rate. These numbers just stay the same. 75 and 90 in the room. Alert trades, 14 and 1, 92% win rate. Made more money in the alert service than we did in the room that month. So that's pretty impressive. But that was obviously good months for both the room and the alert service. And this was the July trades to date. We've got 13 and 1 so far this month. Not a lot, as I said, not a lot of trades. We're halfway through the month. We've only done 14 trades. It's not a lot of trades. We're looking for only very high probability trade setups, but 92% win rate this month, 52.67 so far. Pretty nice. We can continue that through the rest of the month. That would be really nice. Alerts, 8 and 1, 88% win rate, 35.07, 2,000 invested in each trade. So here are the trades that we've taken in July. These are all of them. SMR, we had 37% here, 17, 28. You see the percentages stay here around the same. The time spread, 41% and 50%. Again, one thing I'm going to highlight on these time spreads is they typically generate more profit than some of the other trading strategies that you either use or that I use. They do generate more a higher return. And so this Abbott trade we just did on the 17th, we got in the morning for in the afternoon for $30 a contract, and we get out the next morning for $45 a contract, right on the open almost. For 50% gain, that's really pretty nice. But you can see the consistency here. All right. Now, the alert service basically is going to, just to kind of go over what you get on the alert service, you're going to get an alert that's going to show you the stock symbol, the option strike price, the expiration date, and the price to pay for the option. Obviously, all the information you need to put the trade in. Usually, I send out an alert to get you into the trade and another separate alert to get you out of the trade with your profit target or your exit on a loss. So you're going to get 2. You're typically going to get at least 2 alerts for each trade. If I change the sell price, for example, there'll be another alert that comes out adjusting the sell price. Now, when you get the alert for the exiting the trade, it should be set up as good till canceled. You should put GTC, good till canceled on the trade, so that if you're not at the computer in the morning, then the trade will still execute and you'll still make your money. And it's especially critical on time spreads, because a lot of our time spreads will be in the trade like at 3 o'clock in the afternoon, the morning before earnings comes out, and at 9:31 we're out of the trade. We took our profits and we're out at 9:31, right on the market open. All right, so that's what you're going to get on the SMS service. And again, to kind of reemphasize how we achieve these stunning results, we're able to identify when institutions are driving a trade. I can't emphasize this enough, how important this is. And then I look at market internals to make sure that the market internals are either bullish or bearish. So we only take trades when both of these are in our favor. That's not 100% true. I will take trades when the institutions are in the trade and the market internals are neutral. I don't have to have market internals bullish or bearish to take the trade, but if they're neutral and I've got institutions in the trade, I'll take it. Again, so that's how we achieve these results. How the compass system works, I'm going to talk a little bit about the compass system, but I'm not going to go into a huge amount of detail because it takes a long time to go over the whole methodology that it uses and the data that it crunches. But we do what's called a triple screen assessment. That's a triple screen assessment is multiple time frames, and we do it on 3 different things. We do it on momentum, we do it on trend, and we do it on money flow. These 3 things, and what we're looking at is if the momentum is moving up, for example, on 3 different time frames, trend is moving up on 3 different time frames, money flow is moving up. Money flow is more of a current time frame. If all of these things are true, if I'm looking at the momentum, trend, and money flow all moving up across multiple time frames, the likelihood of institutions driving that trade at that point in time is extremely high, well up in the 96, 97, 98% of the likelihood that the institutions are driving that. So that's how that Compass system does that. And I'm just going to show you quickly before we get into time spreads. This is a visual of the Compass system running on Thinkorswim. I run the software on Thinkorswim. It also runs on Ninja. But here on Thinkorswim, this is just a 5-minute chart on Tesla, for example. But I just want to show you the things that the Compass system has in it. These are the 4 main indicators. This is a long-term trend. This is multi-time frame momentum. This is critical. This is the momentum across multiple time frames. If we were looking at the 5-minute chart, it would show 5, 15, and 45. All 3 of those would all be moving up in the same direction. This is the current time frame momentum. This is the 5 minutes. So we want these, specifically these, to agree. We want them to be either green or blue for bullish, red or yellow for bearish, and you'll see that in some of the charts that we talk about. And this is a derivation of money flow. So it's easy to see here in this chart that everything's green. The institutions are buying the heck out of this thing. This is the chart. This is where we entered right here. You see the stock moving sideways. The Compass system puts out what's called a buy signal, or a pop out of the box signal right here. This pink arrow, this tells you that the stock is breaking compression to the upside, and that would be an entry you would take. This little green line right here, that's a 15 EMA of an EMA. That would be considered the current trend, and it's also a support and resistance level. And so this is the trade we took in Tesla. It bounced off very nicely. There are some other indicators on here we'll go over later, but that just kind of shows you that when you see something like that, institutions are in there, you want to be buying this. All right, so we're going to talk about time spreads here. Just let me take a sip of water. When we go into time spreads, it's going to take a few minutes to do this. All right. So, is there? Give me if you trade over earnings now. If you have a methodology or you try to trade over earnings, let me know if you do. Just put a yes in the question box or a no if you don't, because the time spreads we're going to talk about now. This is for earnings trades. This is very specific for earnings trades only. This is the trade we would take for that. So I call them time spreads. They're actually considered calendar spreads, but I call them time spreads because of the specifics of this setup. All right, so I'm going to show you the time spreads we've taken this year. I think I've got most of them here. Okay, Ralph, good. Yeah, this is, and most people shouldn't be trading earnings because it's a no-win. It's basically a very, very risky trade to take if you're trying to, especially if you're trying to trade directionally. But very, very risky because the option premiums were so high. So this is basically the time spreads that we've done this year. I think I've got most of them in here, probably, maybe not all of them. Now I've highlighted the ones that we lost on are in red. The ones that are yellow, and I did this for a particular reason, these were profitability about 40% or more. And that's 40% on a trade is really good. And if they get higher than that, that's really good. So I've identified the time spread trades that we've taken. The yellow is the ones that are over 40%. Most of them are over 50%. So you can see we had HPQ for 100% gain here. We had Crowd for 36% loss, but we had BMY 40%, 50% in RCL, Fortinet, FTNT at 50%, Groupon 50, PATH 67%, and the rest in white are standard time spread trades that we took but didn't get to the 40% level. All right, so this is the, and you can see they're clustered over earnings season. Obviously, this is January through March here. This was continuation of it, and you can see we had a lot of yellow, and this is really important. This anything you're getting over 40 or 50%, this is a big deal because this really jacks up your profitability a lot. And as I said before, time spreads tend to generate more profit than any of the other strategies do. And I'll explain to you why that is. But this was Ford, 84%, Akamai, 52%, XP, 72%, Sedge, 45, AMAT, 45, HPQ, 50. Again, big gains here. It's Abbott one we just did. a couple days ago, 50% on that. We had a couple of 100% losses here. This is typically what happens is if the stock has something that causes it to go way outside of what the range that the market makers expected. If a stock's expected to move 15% and it moves 50%, then it's very difficult to recover from that. But there's not very many of those typically. We had 34 wins and 6 losses. Again, is that 85% win rate again? That hammering away at that thing, it just keeps happening all the time. So those are the time spreads we took this year. Now we're going to talk about here, we're going to spend a little bit of time on time spreads because it's important to understand when to take these time spreads, which stocks to take these on, what's the criteria that I use to find these trades, because you just can't do this willy-nilly. You just can't be taking every time time spreads on every earnings trade that comes out. It's very critical. But again, this is the only strategy I use over earnings. It's a time spread on stocks reporting earnings after the close today or before the open the following day. So you're taking the trade just before earnings, not a couple of days before earnings, but just before earnings. If you take it on a Wednesday night or Wednesday afternoon, at 3 o'clock, that stock has to be reporting earnings Wednesday after the close or Thursday before the close. That's when you're taking the trade, just before the earnings comes out. The trade is meant to capture the difference of the IV crush and the time decay between this week's and next week's options. Now, we're going to talk about this a little bit. What is IV crush? We're going to go into details on what IV crush is, and time decay is another element that we use. But this is what the strategy is. This is how it makes money, by capturing the difference between this week's and next week's implied volatility and the time decay. Now, it works. This is important. The trade works best on stocks that historically don't exceed their expected move after the earnings release. Now, be careful here. When I say expected move, I'm not talking about whether they're beating earnings or not. And it's not whether they had a good EPS or whether they beat on revenues. It means the stock doesn't move more than what the market makers are expecting it to move, what the expected move is. Because market makers price their options based on what they think the stock is going to do. They don't know which direction it's going to go in, but they do know that it's going to move. So they set their premiums on the options based on what they think. So if they think the stock is going to move 15% up or down, then that's how they're going to set their premiums on their options. All right. So again, the trade works best in stocks that historically don't exceed their expected price move, not the earnings. The expected price move after the earnings release. So harvesting the premiums from the options can be profitable. This is where it gets really, really profitable. So time spreads are entered for a debit, and that is the total risk on the trade, and should be entered and exited as one transaction. Typically, I don't leg out of time spreads. You can, but it's more risk. Anytime you leg out of a spread, you increase the risk on the trade. Time spreads I like because it's a defined risk. If you get in, like we get in for that trade on Abbott for $30 a contract, that was our maximum loss. You can't lose any more than that on the time spread. It goes to 100% loss. That's all you're losing. You can't lose any more. So all the trades I take are defined risk trades. You can always know what your risk is. There is no unlimited risk to any of the trades. All right. So this is time spreads. Now, again, continue now. The time spreads are initiated on stocks that report earnings tonight or tomorrow morning before the open. And it consists of, this is how we do it. We sell this week's expiration at the money, calls or puts. All right, so if the stock is trading at 100, we're going to be selling this week's, for example, $100 calls, and we're going to be buying next week's $100 calls. You're selling this week's calls, buying next week's calls, using the same strike. And this will be done for a debit. All right, so you're always buying this week's, selling this week's calls and buying next week's calls, or you can do it with puts, either way. But I typically use calls. So again, you're going to sell this week's option calls and buy next week's options calls, and it's going to cost you a debit, right? So that's how it's initiated. That's how the stock's set up. Now, after the earnings are released, so let's say we do this on a Wednesday. After the earnings are released, the implied volatility is going to drain or be crushed from both this week's and next week's options. Remember I said that the market makers have to increase the premiums on the options because they don't know how far a stock is going to move based on earnings. Earnings throws a monkey wrench into the market makers' plans because they don't really have any idea how the stock price is going to move. So what they do is they jack up the premiums on the options to cover themselves. And then when earnings comes out, and now they know which way the stock has moved, and they know how much it's gonna move, then the implied volatility that was put into the option prior to earnings coming out is drained out of there, and it's called IV crush, implied volatility crush. This is where we make money, because since we've sold this week's calls and bought next week's calls, we're going to make money as the IV crush comes out of this week's calls because we can buy them back cheaper. And the IV for this week is going to be higher than the IV for next week. So we have a bigger base to go from on the implied volatility. So after the earnings release, the implied volatility, the IV, will be drained out of it from both this week's and next week's options. However, the implied volatility is higher for current week's options versus next week's options, giving us a profit. And this is where we make most of the money, right here in this implied volatility crush when it comes out. And you can even do better than the reason that we make more money on these than we do on some of the others is because the market makers, when the market opens in the morning and they're taking the implied volatility out of the premiums, what happens is the option bid-ask spreads sometimes will fluctuate tremendously. They'll be very wide, narrow, then go very wide again, and you've got people in there buying and selling options at market. And what happens is if we've got an order in there to make 50% profit on the trade, we're much more likely to get filled when the spreads are really wide like that, because somebody's going to go in and put a market order. We're going to get filled, and we're going to take a bigger profit. And that's the reason that we make more money on time spreads than anything else, because we're actually taking advantage, exiting the trade, of the big, huge, wide spreads on the bid and ask. And normally you can't do that. When you're trying to get into a trade, it's a problem. But when you're getting out of a trade, it's great, because as long as you've got your profit target already set, then that implied volatility crush and the wide option spreads are going to be a big help. Right? So I don't want to get into huge amounts of detail, but that's why this works. All right. So again, after the earnings are released, the implied volatility will drain or be crushed from both this week's and next week's options. However, the implied volatility is higher for current week's options versus next week's options, giving us a profit. Now, one additional element that adds profit to our trade is the time decay that's going to be impacting this week's calls that we sold. Is going to be much faster than the time decay for next week's calls, because obviously there's less time between this week's calls and expiration than next week's calls and expiration. So we actually gain money because the time decay is going to come out of them faster as well. And that's what those two things really enhance the time spread and increase our profitability on these things. This is really a critical thing. And like I said, I've been using this for 2.5 years. I've not seen it just talked about anywhere else. But I learned about it by looking at my trader view where my trades were done, and I was able to make some sense out of this. All right, so this is going to that's obviously going to allow you to buy back this week's options and sell next week's options for a profit of 15 to 50%, sometimes higher than that. Sometimes you only get 10%, but sometimes you'll get 60, 70, 80%, as you saw on the trades that we were talking about here. So this is the time spread strategy that I've just explained to you, and this is really critical. If you're not familiar with this, this is a huge weapon in your tool belt of trading that you can do over earnings. You just need to make sure you identify the criteria. All right, so again, let's just make sure we understand what volatility crush is. The volatility crush is the additional premium that was included in the options prior to earnings due to the uncertainty of the stock price's reaction to the earnings report. Not the earnings report itself, but the uncertainty of the stock price reaction to it. Immediately after earnings are released, the additional volatility that was included in the option premium drops rapidly or is crushed. Again, that's what we're harvesting. If you select stocks that have a specific criteria just prior to earnings, the volatility crush can be captured for nice profits. Okay, and I'm going to go over the specific criteria here now. All right, so all the trades are going to be calendar spreads. I call them time spreads because we're only using this week and next week. Again, here's the structure again. selling this week's option expiration, buying next week's options expiration at the same strike. It's the time spread is captured to capture the implied volatility drop after the earnings are released and the difference between this week's options volatility and next week's. It also captures the difference between this week's time decay and next week's time decay. Again, the trade is entered just prior to earnings. Enter the trade the afternoon before the earnings release occur, after the close or before the open the next morning. And again, we try to make 20 to 60, the percentages change, but it's pretty high. After the open in the morning, the take profit order should be active before the market opens. This is really important. When you're exiting a time spread, you want that trade to be active at the open. When the bell rings, that trade needs to be working, because that sometimes is the best time that you can get filled, because those spreads are so wide that you could get filled. I mean, I've had people go in on trades that I've had, and I get in and I'll get out and I make a 60% profit. I've had other people in the room make 150, 200% on exactly the same trade at the same time, because the spreads were so wide. That's what is such key here. All right, so here is the criteria. Obviously, the stock's got to have weekly options. You can't sell this week's calls and buy next week's calls if it doesn't have weekly options. So it has to have weekly options. The stock has earnings announced after today's market close or prior to the market open tomorrow morning. We've reiterated this a couple of times now. Implied volatility. Now this is important. The implied volatility between this week's option and next week's option has to be a large percentage difference, like 40% or more. So if you've got implied volatility this week of 100, and you've got an implied volatility next week of 50, then you've got a 50% difference between this week's and next week's implied volatility. That's what you want. You want a 40% or more. If you've got an implied volatility this week of 100 and next week of 85, it's not enough. That's only 15%. That's not enough of a difference. So the implied volatility between this week's options and next week's options has to be a large difference. And this is what I look for when I put out implied. People in the room and people in the alert service, they don't have to go through this process because I'm giving them the trades, but it's important for people to understand how this works so they can do it themselves. Historically, the trade should move less than the expected move at least 80% of the time or more after earnings. The less frequently exceeds the expected move, the better. What that means is if the market makers are expecting the stock to move 15% up or down, you want a stock that doesn't move as much as the market makers are expecting it to. You don't want it to exceed that move more than 20% of the time. The less, the better. I mean, there's a lot of stocks that are at zero. They never beat what the market makers are estimating. So that's another thing is that needs to move less than what the market makers are expecting it to move. And there's ways to do that. I have a program that I use that it shows me what historically these stocks have done and how often they beat and how often they don't. You want to enter the trade the afternoon prior to tonight or tomorrow's morning's earnings season release, and you want to close the trade for a profit after the market open if possible. I say 20 to 40. Basically, it's 20 to 60 or 70%. If the stock price moves more than the expected move, you may have to take a loss or make an adjustment to the trade. And I go into some details on a video I did on time spreads is what the adjustments can be, but there's ways to make money when it even goes against you. All right, so that's time spreads. And if you have any questions on it, please let me know. I'd be happy to answer them for you. But this is really a great strategy that most people have no idea about. All right, now what I'm going to do is I want to go over some of the Compass trades. I want to show you the Compass system and how it works. Some of the trades we've taken in the alert service and on the room, and how we identified them and why we took them. All right, so again, it comes down to the Compass system here. This was when I showed you before. This is Tesla, all green, easy to see. But let's go over some details here. This is a daily chart on Gilead, right? So this was what's called a Fibonacci reversal. This is another strategy I cover to when you have candles that are non-standard candles. These are Fibonacci candles. But again, what you want to see here is you see the blue and green. The institutions are buying the heck out of Gilead at this point in time. And these are daily charts. See all the green. I mean, there is no problem with being long Gilead all the way through here. GE, this was another Fibonacci reversal. Again, I'm not going to cover Heikin-Nash reversals today. I do that in a separate webinar, but I do have if you're in my room or in my alert service, I do have a webinar, a video on all of these strategies and how to use them. But see this was a Heikin-Nash reversal here again, and you notice that everything is here is green except for the long-term trend, which went to yellow here, but everything else was green. All right, so I'm going to go some of the recent trades we've taken, and these are high probability trade setups, and I'm just showing you these because I want you to be able to visualize what I'm seeing. This is the chart that I have up in the room every day. I have the my Thinkorswim platform up with the compass system on it, with some scanners on it on the side as well. But this is, for example, this is SMR. We had this for 2 days. Now this is a daily chart, and you'll see here, this is the compass system. Again, here are my indicators: long-term trend, multi-time frame momentum, current time frame momentum, money flow. Are the institutions in here? They certainly are. Now the compass system generates this this shaded area right here. This is called the dynamic compression zone. This is a zone that the compass system produces to tell me that the stock is in compression. And I also have the pop out of the box symbols that I showed you. But this is showing a breakout of the dynamic compression zone right here on SMR. All right, and so this is where we bought it. As it popped out of this dynamic compression zone, all green, institutions are in there. Trend is up. You can see the green line here, the thin green line. Trend is up. Bought it here. We were in the trade for 2 days, 64% profit in SMR. Really a nice trade. Now, this is the daily chart in SMR. Remember I said the daily chart, if I'm going to go long, has to be bullish. So the daily chart's bullish. This was the day we get into the SMR trade. This is the 5-minute chart. All right, so here I am looking at the SMR right here, and I'm looking to see a couple things. I wanted above the VWAP. See this pink line? That's the volume weighted average price. It pops above the VWAP on this right on this pop out of the box symbol, and then the compass system goes from yellow to blue, from bearish to bullish on the 5-minute. It's already green on the multi-time frame, so it's bullish. So this is where we get into the trade at the top of this candle, and this is where we entered the trade. Now we didn't get out that day. Remember I told you the trade lasted 2 days, but this was our key entry on the 5-minute chart. I used the compass system to tell me when to get into the trade, and I used it on the daily chart to let me know whether I should actually be taking the trade or not. All right, we'll cover a few more things here. This is workday. This was a 5-day trade. We get in took a 30% profit. Again, you can see we get a little choppiness here, so we had to be a little cautious, but we had enough blue here green on the current time frame, which is daily, telling me that everything is bullish, even though the current multi-time frame is chopping around because the stock had been so choppy here. The current time frame on daily chart had switched over to completely bullish. So I felt okay taking the trade right here. Now the VWAP here this is on a daily chart. This pink line is not used on a daily chart. It's only a 5-minute chart that I use there. This was the entry right here on workday. We had this for 5 days and we made 30% profit on workday. MDT, this is a medical equipment manufacturer here. Again, 25% on a swing trade. You see we went from yellow to blue here in the current time frame. Momentum, this is the daily chart. So this is the current time frame went bearish, bullish. But we cut the multiple time frame was already very, very green. Lots of green here on the multiple time frame as well as a trend. So we were pretty bullish anyway. But once I get this break right here on this arrow right here, this is where I took the trade, and we were in this for I think a couple of days. Looks like about 5 days. We get in here and we get out here. We had to ride it along for a bit, but never were in any danger. Vertex right here. Nice trade here again. Everything went to green. Everything's green. The whole point here is to show you that the compass system, when you look at any particular stock that you're looking at, it's going to tell you whether the institutions are in it or not. You can see right here they're in the trade. All right. When you're over here, if you look here, you see you get blue here, you get green here, and you get red here. The institutions aren't trading it. They're not here. They're not in there. It's all mixed. But now it goes to green. Now the institutions are telling you that, yeah, we're in the trade long right now. So that's what we take it. Here's McDonald's. This was a nice overnight trade for 37% gain. Everything's green in McDonald's. Now I don't enter it just because it's green. I need to see some technicals here. This is compressing. I'm not going to go ahead and take it when it's compressing. I'm waiting for a break. And you see here, I get a pop out of the box signal, the pop, and it's coming out of dynamic compression. So it's breaking out. Right here is where I get into the trade. I held it overnight, out here the next morning, in for 8.30, out for 11.30, a $3 profit. Everything's green, and I can see this break right there pretty clearly. Moderna, obviously shorts work too. This was Moderna coming off of a dynamic compression zone. See this shading? Right here it is coming out right here. This is where we bought it. This is the daily chart. Took this for a 33% profit on Moderna. It just keeps on going down. Everything's red. You can see how it's yellow and red here. Institutions are selling. Over here, you don't have that. You don't have that information. You've got yellow, red, green. So this is, you're not going to touch a trade when you're getting this kind of correlation. There isn't any correlation. You're telling you that the institutions are not in the trade. Then all of a sudden, here they come. Going to red, goes from green to yellow. Everything is red or yellow. They're back in the trade short. Amazon, again, same thing here. Now the multi-time frame, the long-term trend here was yellow when I took the trade, but everything else was green. And it was the reason this long-term trend was yellow is because of all this chop. But I'll go ahead and take those if I'm convinced the institutions are strong, which they are here, obviously, and which if the stock technical setup on the daily chart was bullish enough, which it was here. You can see it's breaking out. A JD, 61% profit. We just took this over in one day on this breakdown on dynamic compression. You see it went from here, we went from green to yellow. The compass system is telling us that everything's bearish now. This went from bullish to bearish, but lined up with everything else being bearish. We took the trade right here, 61% profit. So this just kind of shows you the compass system and how easy it is to identify whether institutions are in the trade, because this is what you're going to do is look at a trade, look at a chart and see if the institutions aren't in it, then you ignore it. You're not going to take the trade. You just move on to another one. This was Dollar Tree. This was a nice breakdown here. You see this big candle breakdown after this compression here? So we took this on this big breakdown. We knew that the institutions were selling it. We weren't worried about any kind of an immediate reversal, and we got 25% profit. Datadog, same thing here, 21% profit coming out of dynamic compression on the daily. There's a dynamic compression zone breaking down here. Everything was yet red or yellow. Institutions are selling. Crowd, same thing here. Again, we have the watch here now because you notice we get a little bit of choppiness on the daily chart with the current time frame momentum, but the multi-time frame momentum switched over to blue. And the trend switched blue, and the money flow went to green. So this was important to me because the daily chart was now telling me that it's bullish. This is starting to try to recover from this choppiness, but it's fine for me to take that trade right there because I had green, blue, blue, when that was fine. Took 20% profit on that. This keeps switching back and forth. Probably not something I'm going to stay in a long time until this all moves over, but it gave me plenty of profit. This was right after earnings, by the way. That's earnings right there. Amazon, same thing here, 32% profit. This is a 5-minute chart. We get in here, we're in this trade 45 minutes. Notice we got green, green, green. The long-term trend was messed up because of the choppiness, but I'm happy with this and this the multi-time frame, current time frame, both green. Institutions are in there, 32% in 45 minutes. ENPH, 20% an hour, same thing. Institutions selling, compression, pop out of the box to the downside. All right, so this is the setups that I look for. This was Verizon. We took 50% an hour in this one. You notice it's breaking below the pink line, the volume weighted average price, the VWAP. It got to pop out of the box. Everything, I mean, look at this. Are the institutions selling? They certainly are. It's moving sideways, but they're selling the heck out of this thing. So we jumped into this. We paid $45 a contract for this, and we get out an hour later for $67 a contract. Basically a 50% gain in an hour on Verizon. All right, and this was I talked about the SPY super system when we first started the webinar. This is a system that I use. What I'm looking for is I'm looking for an entry for the SPYs or the Qs, either bullish or bearish, it's confirmed by a few things. A, you notice I got a pop out of the box symbol on here, which means it's breaking compression. So that's a good one for me. Trend is moving down. It's below the VWAP on the 5-minute right here. So this is a bearish setup. Is it bearish here? Yeah, the institutions are all selling the SPY right here. They're all selling the SPY. And I also looked at my market internals. I don't have them here, but my market internals also showed bearish. So that becomes a SPY super system setup. And I take this, and I'm typically only going to ride this for 5 or 6 or 7 candles or something. We rode this down. As soon as I see any kind of hesitation in momentum, I'm going to get out. I likely get out right here. As soon as I started to see some green, I get out of the trade. But it's a nice profit if you're trading the SPYs, the Qs. You can trade the ES. You can trade futures off of this as well. You can have the ES up here or the NQ up there, whatever you want. It'll trade off of any of those. Netflix, this was a nice 20% profit. So again, these are fairly redundant, we're seeing the same thing over and over again, but I just want you to see the compass system. See here why I get in? See, it went from blue to yellow and everything else was red already. So I know I get a breakdown. It's coming below the VWAP on a 5-minute with a pop out of the box symbol. Perfect place to enter. I mean, perfect place to enter. And took 20% profit, got out down here. Rode this thing down. And Tesla, this was a nice 30% profit, same thing. Stock, everything was weak. It went from blue to yellow here. Everything was yellow or red. Institutions are selling. You can see the institutions are selling. And we went ahead and rode this thing down, 30% profit to the downside here on Tesla. This was right at the end of the day when we get out. And I did hold a Tesla trade overnight here. On this one, this was a pop out of the box symbol on the 5-minute chart. It was below the VWAP. I had everything red or yellow, so I knew the institutions were selling it. So I took it overnight on Tesla here. And we got lucky. I mean, we got lucky because the stock gapped down from 120 to 112. Our puts exploded, obviously, and we took profits down in here, about $7.50 a contract on that. That was a big one. So sometimes I'll do overnights based on that close to the end of the day. And you've seen this one before. That's the reversal. HINDSIGHT just wants to point out the fact that I do use a daily chart. As I said, the daily chart's critical. So the daily chart has to be bullish. So this is a trade I took, QSR. First thing I looked at is the daily chart. Was it bullish? It was. See how we got yellow, blue? Now we got blue and green across the board. So the daily's a bit bullish. So then I look at the 5-minute chart. Where do I want to take this trade? All right, so I'm watching and this is just on my watch list. I'm watching it, and I get a pop out of the box symbol right here as the stock breaks above this 15 EMA right here, this little green line. You see them above the VWAP, so it's bullish. You see how this went from red to blue and everything else is green. The institutions are buying it. So the institutions are in it, I want to be in it. So this is where I entered QSR right here off of that entry based on the fact that the daily chart was also bullish. Okay, so that's kind of the recap of the strategies we use. And we've talked about the compass system, how I find institutional trades being in a trade and how important that is, and how important it is to be using relative strength and relative weakness. Again, here's a recap of the strategy we use. I went over this already. Straight calls and puts, debit spreads using weekly option expirations, weekly options expiration for this week, time spreads that we did quite a bit of detail on, over earnings, a non-directional trade, very important, a non-directional trade that we take. We don't care which way the stock moves. The weekly ATM, which is a way I capture premiums by selling puts each week against a long-term dated put. Credit spreads that are fairly common, basically just to capture premium over a few weeks. And the SPY super system we talked about. This is pretty much most of everything we do in the room and on the alert service. All right, and again, that's what the alert looks like on the system. So what I want to talk about is I want to talk about the offer that we've got today and what you can get for it. And you've seen the results that we get in the room and on the alert service. This is what the alert service is being offered for. Really nice trade here, a really nice offer. Again, it's for a quarter, $4.98, 3 months. Again, you've been see this month alone we're up, but $2,500, $3,000 or something in the alert service. But alert service $4.98, annual just $14.96, and lifetime. A lot of people don't want to have to re-up all the time, so $24.96 you basically have it for the rest of your life. This is the sale ends on Sunday, but this is just for the alert service. Now, if you take the alert service, you're going to get a month in the live trading one for free. You're going to also have access to the Discord chat and SMS text alerts. Obviously, you're going to get the text alerts. But we have a Discord room where we have 2 other professional traders in there, answering questions, posting trades, doing dialogue with folks. It's just another great educational element to our room. And then I have videos, about 30 of them, a wise way to trade options. This is on all of our strategies, the compass indicators, how to find the highest probability trade setups. There's one on time spreads. There's one on weekly ATMs. There's one on Fibonacci candles. Everything we do in the room there are videos on all of that. All right, so this is for the alert service. If you want to trade, get into the room, the live trading room, again, this is a 50% off as well. So for a full year, $11.98, which is really a good deal. Because again, $60,000 last year was the profits. $11.98 for the year. Monthly, if you want to try it for a month, $148. Not my favorite thing, just because I don't think you can get, enough feel for the room in a month. But that's up to everybody to decide what they want to do. But again, right here, a year for $11.98 and a month for $148. Obviously, you're going to get access to the live trading room. You'll also get into Discord instant messaging, which is messaging where all the trades that I post in the room are going to be posted. And then you'll get obviously have access to the videos again. So this is the actual trading room. Now, if you're interested in the compass system, which runs on Ninja and on Thinkorswim, you can actually buy the software for 50% off right now, $12.49 for a year. And you can try it for a quarter for $5.98. So that's those are your options as far as the compass system. Now, on the compass system, if you buy the software, you'll get a month in my room for free. You'll obviously get the Discord, and you'll also get the options videos that I produce, the wise way to trade options, and you'll also have access to the scanners. It's going to look exactly like my compass system does on Thinkorswim with the scanners, etc. But you'll be able to get all of those if you buy the compass system. So again, $12.49, $5.98 for a quarter, and if you want to get into that. Now, I think Rory has posted, there's links in the chat box now of all 3 of these offers. Again, if you want the alert service and you don't want to be in the room, you do get a month for the room for free. But if you just want trades coming to your phone, this is what you would do: the Compass Alert Service, $4.98 for a quarter, $14.96 for a year, and $24.96 lifetime. And at the trading room, if you want to be in the trading room, this is the offer for that, $11.98 for a full year. And your Compass software right here, which now the software is installed on your Thinkorswim or your Ninja platform, and Rightline does that for free. One of the techs, most likely Sergio, who is got a master's degree in computer science, he put it on my machine. I didn't have to mess with it. I'm not that great technically with that stuff. He'd just take over your machine. He'll plop the software on there. It'll look exactly like it does for me, and you're up and running. Really, really quick. All right. So those are the 3 offers. Again, if you have any questions or you would like Rory to give you a call back, just put your name and number in the question box. But other than that, that pretty much wraps up my presentation for today. It took a little over an hour, but I appreciate everybody being here. Appreciate all the questions and the attention. So again, everybody have a great weekend. I hope to see some folks in the room or on the alert service come Monday morning. So have a great one.